ISG is helping our clients on their continuous journeys to digital transformation, operational excellence, and faster growth. Through uncertain times, we are here to help you get the most from your digital investments, delivering integrated digital and enterprise solutions and providing the best advice and support across borders and time zones. We are a leading global technology research and advisory firm, but we are more than that. We are the ones who get it done for you. Okay, well, thank you, and good morning, everybody. My name is Mike Connors. I'm the founder, chairman, and CEO of ISG, and with me today is Bert Alfonso, our executive vice president and CFO, and we thank you for spending a couple of minutes with us on our story. Let me start with one slide, which is what we call our firm on a page. We are all things technology, all things digital for large enterprises around the world. We focus on what we call operational excellence for large corporations. Most companies that are large have technology budgets somewhere between $50 million and $3 billion, if you think about some of the banks, the General Motors, etc., and we deal with all of them. We have revenues of about $280 million, EBITDA closing in on $40 million. We are a cash machine. We have very little CapEx, $2-3 million a year. We have now nearly 1,500 employees operating in 20 countries around the world. We have 800 clients. They are all the largest blue chip companies, and we'll talk through a little bit of those, including 75 of the top 100 largest enterprises by revenue around the world. Our revenue is 85% of what we call reoccurring. These are revenues that come from clients from the previous year. The difference in the revenues by client may vary year to year, but the clients and the aggregate of the clients generate 85% of our revenue every year. We are what we would consider just in the middle of our digital journey. We started on a strategy that we publicly stated actually here at NobleCon several years ago called Go Digital. This was pre-COVID. This was a little bit on the early stages. And of course, COVID hit and everybody's digital enterprise is now being accelerated as a result of what they learned during COVID. So we're kind of right in the early middle stages of our journey. We essentially do three things for our client. We help them with digital, and digital for us, we call it all things digital, is everything from cloud to customer and user experience to data analytics to automation. Those are the areas that most enterprises around the world are working on today, and we refer to that as ISG Digital. As part of that ISG Digital, we are the largest sourcing advisor in the world by a factor of 4. We own a more than 50% market share, and this is when we advise clients on large enterprise technology contracts with the likes of IBM, AT&T, HCL, Capgemini, etc. We have a very solid market share there. The second area is what we do is inform our enterprise and provider clients through research. Think about it as subscription research, annuity revenue stream for us, all things on digital and technology. We focus it on emerging technology topics. And thirdly, we have our own proprietary SaaS platforms, including our largest one we call GovernX. This is the vendor management software that large enterprises like Marriott and others use to help them manage, monitor, and risk mitigate their provider contracts. So think of IBM with Marriott, might be a contract that's worth $400 or $500 million a year. That means I'm getting a bill for $20 to $25 million a month at Marriott for the IBM contract alone. How do I know that I'm getting value for that contract? That is where our GovernX software comes in, and we couple that with services. When we think about digital, as I said, there's a lot going on and everybody uses different definitions, but these buckets are the ones that most enterprises are working on today. whether that is slimming down or modernizing their applications, whether that is improving the customer interface or the customer experience, whether that is moving workloads to the cloud, whether that's private, public, or some hybrid, and of course cybersecurity and all things around the workplace, especially coming out of COVID. Now, how have we kind of laid out from an investment thesis kind of our next 3 years? First is that we have committed to deliver on high single-digit revenue growth on the top line, and we have a track record of beating that number. Last year we grew by 12%. We also talk about leveraging what we have, and that means for every percent growth on the top line, we think we can get 1.5 times on the bottom line. So if we grow by 10%, we should expect to see EBITDA growing by 15%. And again, our track record shows that we beat that 1.5 times. We also set a marker back in 2020 to achieve $100 million of recurring revenues. Recurring revenues, that's revenue that we define as you wake up on January 1 and that revenue is contracted for at least the next 12 months. We did $92 million last year, $60 million 3 years ago. You can see how we have accelerated our recurring revenue streams. And then finally, and Bert will talk about this, and that is we have a very efficient use of the cash that we generate to redeploy it to our shareholders and also for M&A areas. Now, what's our addressable market? It's big. We play in the global services market. You can see it's very large. Part of that market is the sourcing market, which is a slice of what we operate in, which is a little over $100 billion a year in sourcing contracts. Out of that $100 billion, there's a third-party advisor like ISG that assists in around 25% of that market, or called around $25 billion a year. And ISG gets about $17 to $18 billion of that each year. Here's just one client example, kind of going from the left to the right. This is a top 3 enterprise company in the world. Initially, they asked us to come in and take a look at their software. They had a lot of licenses for their almost 100,000 employees. They're spending X number of dollars. Come in, can you benchmark it? Are we spending the right amount? The right users using it? Have we been upsold over the years, etc.? And that is a typical way we enter a large enterprise, is with some piece of work, whether in this case it's software, other cases it might be, let me take a look at my network. Now that I know that I'm doing a lot more video, etc., I need more network, maybe more 5G capabilities, etc. As part of that work, then, we normally take a look at their entire technology spend. They give us all of the data. We load it into our database. We compare it to their peer groups. And we come back to them and say, look, you're spending $400 million in this particular area. Your peer groups are spending $300 million. We have opportunities for you to be able to save $100 million and either take it to the bottom line for increasing your earnings per share or for redirecting that into more growth initiatives. And then we kind of move into a strategy. Well, how would we execute against that? How would we capture that $100 million? We lay out a strategy for that. They then ask us, okay, now that we have a strategy, we agree on it, let's go execute against that together, and we will do all of that work. And you can see how all of those areas kind of roll from the left to the right, and what starts out as a few $100,000 client turns into a multi-million-dollar client. And that is how all of our enterprise clients, for the most part, work with ISG. As I mentioned earlier, we do operate in 20 different industry segments. I selected 6 of those segments here just to give you a flavor. In almost every category in the top 15 or so enterprises by size in these industries, we tend to have 10, 12 or more of the top 15 clients. Again, we give very great ROI to our clients. Using the past example where I said we could save $100 million for them, our fees there, you saw what it was, a few $1 million in order to save $100 million. So the ROI is great, and that's why we have 85% of our revenue reoccurring with the same clients year after year. We also are recognized in the market as the authoritative voice in this industry. We host every quarter what we call the ISG Index, have now done it for 75 straight quarters. All of the key financial analysts that follow all the technology firms, the IBMs, the Accentures, the Capgeminis, the AT&Ts, they're all on the call. We have about 1,500 people on the call between the analysts, between enterprises and the providers. And what we provide them is an analytical look of the state of the industry for the recent quarter. And we can say who's the winners, who are the losers, who's winning the large deals, who is not. And we go through all of that with them in about an hour and 20 minutes each quarter, and we do that to keep our brand, and because we're widely quoted through this index every quarter by all the analysts that follow the tech companies. Now, back during the COVID era, back in March, April of 2020, we changed our business model. And what you have seen since then is a dramatic step change in our financials. And it's done in 2 steps. Step number 1, we simplified our business that we help enterprises run digital, or we will help them run their enterprise that may not be related to digital. So think about human resources or procurement or some areas of finance, accounting, business operations. That's what we refer to as operations or as enterprise. And from a digital standpoint, we mentioned it earlier, it's all things cloud, customer experience, data analytics. That was step 1. Step 2 was that we launched what we called our Iflex delivery model. Because we were born virtual as a company when I founded it in 2006, we have very little real estate cost around the world. We have a corporate headquarters in Stamford, Connecticut, 25 people. It is the largest real estate that we have, and it's 15,000 people. We have a training center, etc. That's it. So all of our teams have either worked from home or worked from client premises since 2006. Now COVID hits, and now our clients are working from home. And so we switched to what we call our Iflex delivery model, because now we don't have to be deployed to Microsoft in Seattle or to Stanley Black & Decker or to Pitney Bowes in Stamford, Connecticut, or to BNP Paribas in Paris. We can now work and deliver our services remotely. Clients got used to it during COVID, and what does it do? It helps us be much more efficient, much more effective, and from the client, it's a much more efficient and effective fee structure for them. So this allows us to use our cyber people in New York to help us with work going on in Frankfurt, Germany, or having our people working in London help with work on the West Coast with people like Google and others. So the delivery model has enabled us to increase our productivity, increase our utilization, and you can see the financial results with a dramatic change in the EBITDA. We call it ISG Next, and we committed to drive EBITDA margins up by 400 basis points over 2 years. We are well on our way with that, with over almost a 300-point improvement in 2021 alone. So you can see how the model has really driven a significant step change in our financials. Now, the competitive landscape. We don't have anybody that looks exactly like ISG. So we have different competitors in different aspects of what we do. The number 1 competitor is the large procurement departments in these large enterprises, at the General Motors, at the Deltas, at the Exelons of the world, where they would say to their end user, the CIO, the CFO, the CTO, who is the buyer of our services in the C-suite, hey, look, you don't need ISG or anybody else. We can do this for you. That's our number 1 competitor. When you get past that, then we'll see Gartner in our benchmarking when we're looking at the data, compiling all of the technology spend and comparing it to our benchmarkers. Gartner and ISG are the 2 largest in the world, and both of our names tend to be on these large sourcing contracts that all have an out clause in them for the most part for these enterprises that says we can do a benchmark halfway through our contract if it's 4 or 5 years at the 2.5 year level, and you can either use Gartner or you can use ISG. So we see Gartner in the benchmarking. And then in some of our execution services and consulting, it varies around the world. We might see KPMG or Deloitte in the United States. We might see PwC over in Germany. That's the competitive landscape for ISG. Now, what's our competitive advantage? Number 1, we're independent, third-party, objective. We are not affiliated with anybody. So when an enterprise says, look, should we look at IBM, Accenture, Cognizant, Hexaware, Softtech, what are your views? And when we give them their views, they are independent and objective. Second, and most importantly, everything we do is driven around data, our data assets. We gather all of the data that we get from all of our engagements, again, an over 50% market share each year in these engagements. We gather up all that technology spend, put it into our database, and we utilize that database in all of our advisory and in our research business. Of course, we anomalize it. We don't let anybody have a course look at who's who, but we will look at what the companies are that they want to peer group and benchmark against. But the data asset is the most important thing in our firm. And having come from Nielsen, which is all about data, that's how we began and launched our firm, which is a data-driven organization. So with that, I'm going to pause. I'm going to hand it over to Bert, and he's going to walk you through a few financials, and then we'll open it up for your questions.
Thank you, Mike, and good afternoon, everyone. I'm going to, let me make sure I have this in the right direction. I'll take you through a few slides just to give you some of the financial parameters and how we think about capital allocation and some of the performance. Now, the information that you're looking at is from last year's 12 months. We don't report our first quarter till May 10th, so stay tuned for those. But what we want to see on this chart, if you look at our revenues, our EBITDA, as well as our adjusted EPS, I would point you to the longer term trends, which are good in and of themselves in terms of the CAGRs, but more importantly, as Mike mentioned earlier, with the onset of the pandemic and the increase in demand around research in technology and transformational investments by many of the largest firms, you can see that we've accelerated significantly both at the revenue line as well as in our profitability over the last 2 years, and we see that continuing into the future. Mike had already mentioned that we have an algorithm where we believe we can consistently over the next 2 or 3 years grow our top line at the high single digit level and our EBITDA at 1.5 times that. We have a strong balance sheet and it's improved quite well over the last couple of years with the improvement in profitability, and we have strong cash flows that are generated by the business. We ended last year with $48 million in cash. We have about $75 million in debt, but on a net basis, that debt is about $27 million. And you can see in the small print on the bottom, the trailing EBITDA debt to ratios are below 2 and below 1 on a net basis. So we're, if anything, under leveraged and have a strong balance sheet that gives us a lot of flexibility going forward. And we have about 49 million shares. And I'll talk a little bit about how we think about buyback in terms of our capital allocation. This is another look in terms of the cash flows from operations. You can see a significant increase over the last few years, again, as demand has increased for our services, as our recurring revenues, which have good margins, have increased as a percentage of total revenues, as well as the portion of our portfolio that delivers digital transformation versus enterprise, which also is commanding higher margins. And with that, you can see the opposite being true in terms of the debt side of the balance sheet. Cash balances, no doubt, I've already mentioned, have increased despite the fact that we've been quite active in terms of returning cash and value to our shareholders. This chart's a little bit dated. Last year we had a terrific year. Our shares were up 130%. They're down obviously in the first quarter. We're still ahead of the indexes, but it's been a choppy market, and I won't get into that. Obviously we don't believe we're trading on fundamentals, and goes without saying. We believe that over time the fundamentals will drive our shares versus what's happening in the marketplace today. But really a terrific year last year and our best year in the firm's history. I talked about capital allocation, so I'll give you a sense of how we think about it. We really have 4 priorities that we think about. One, the most basic, is really we will continue to pay down our debt. We have a sub 2.5% interest rate, so we're not in a hurry to pay it down. We'll just pay it down at the normal intervals. And if anything, as I said, we have plenty of room should an opportunity arise for further investment. Last year in the second quarter, the board approved the initial quarterly dividend. There had been some one-time dividends in the past, but with the strength of our balance sheet and with confidence in the future, we've introduced a quarterly regular dividend that was introduced last year, and our intent is to grow that dividend over time with our increase in profits. We've been quite active, particularly last year, in share buyback. We bought back about 16 million of our shares in terms of dollars, and we continue to think that that makes sense for us. While we don't have a stated policy to keep our stock-based compensation from diluting our share base on a quarterly basis, we do plan to do that over time, and we've been quite successful in doing that. And so we believe that our dividend program as well as our share buyback program really offer good value for investors, not only in terms of our history, but going forward. And then finally, I would point to M&A. Mike slightly touched on it, but the firm's been very, very active. Over the last 15 years, there have been 10 bolt-on acquisitions. We think of it as a string of pearls strategy. These days, we're very focused in the areas where we see the most growth, be that cyber or some of the other digital areas that Mike spoke about earlier. We're quite disciplined in how we think about the marketplace. We look for opportunities where we have zero to no dilution in year one, and certainly no dilution in year two. And we look for firms that really complement what we do today, as well as bring in new talent. So that's our fourth, I would say, focus area around investing in the firm. And obviously, we don't put that into any of our algorithms, so it's not included in what we mentioned earlier around revenue and EBITDA growth. So this is my last slide to bring you to what we believe is the investment thesis. We have a strong management team, lots of industry experience. Many of our advisors and professionals come from the larger technology firms around the world. We already talked about some of the transformation that's happening within our own firm in terms of more of our revenues coming from digital transformation, as well as higher recurring revenues, which are more valued in the marketplace. We believe we have a blue chip board and a diverse board, which we're very proud of, with both industry experience as well as finance and other experiences that they bring to us. And we are really driven by a focus, really laser focus on providing the best possible services to large clients all around the world in multiple geographies. I'll stop there and we'll switch to the Q&A. I'll turn it back over to Mike, and if you have any questions, we'd be happy to address those. Thank you.
Any questions before we wrap? Yes, sir. Yeah. So our guidance is, over the long term, high single digits, 1.5 times bottom line. Our objective is to always beat that. We grew last year by 12%, driven by all things digital. Digital transformation, cloud work, network work, and customer experience and data analytics. That's what big enterprises are looking to do, is to transform themselves, which goes right to our sweet spot, and that's why the growth was where it is. Again, we expect, internally, we always expect to beat those targets that we set out publicly. Yes, thank you. Yes, sir.
Real quick, consultant utilization, where you stand on that, and how much more do you think it can go up given the Iflex model?
So great question. Utilization 2 years ago ran in the mid-60s for us. By the way, we use 2,080 hours as the denominator, just for clarity. This past year, we've been in the mid-70s. And I think that we can reach a bit higher than that. Best in class is kind of 77, 78. You're not going to get much higher than that. So we're getting close to what we think we can do on a sustainable basis on utilization. But it has grown almost a little over 900 basis points over the last 18 months since we installed it.
Thank you very much.
Yep, thank you.
Thank you.